Well, KB Home cutting its revenue outlook for the year after reporting weak second quarter results. This is the housing market. It remains sluggish, with existing home sales seeing their worst May since 2009. Joining me now, we've got Meredith Whitney Advisory Group CEO. Meredith, good to have you back on Yahoo Finance with us. We just heard remarks from Fed Chair Jerome Powell that he plans to keep rates on hold. So what is the risk that poses to the housing market?
Well, the housing market looks like it's going to be up for its worst year in decades. So last year, 2024 was bad. The prior year, 2023 was bad. We're on pace for about 4 million units of existing sales this year. And I think actually we're going to come below that. That's significantly below estimates. And that poses a real problem for the general economy because it's such a big contributor to GDP. So not only do you have when someone when a family moves, they buy a lot of furniture, do renovations, spend at Home Depot. The NAR estimates that it's about over 14% of U.S. GDP comes from home sales. So it has ripple effects across the board. I think that the Fed is in a tough spot, and I don't think the housing industry is going to benefit because you have I think wage inflation and real inflation from goods inflation, and then you have a slowdown in the economy. So we don't expect the housing market to improve that much, if at all. We think it's going to weaken throughout the year.
What role does the generation that is still kind of sitting on homes, locked in low interest rates? We've heard that the baby boomer and the kind of silver tsunami even generation is less likely, according to some of the recent surveys from Redfin as well, to actually sell their homes or list their homes because they are in such a sweet spot right now. How much of that is also impacting the equation?
You bring up a great point. So we estimate that over 60% of existing homes are owned by households over 60. And what you see now is the AARP cites that they want to age in place. And what's more, the Joint Center for Housing Studies at Harvard says that only 1 in 10 seniors can afford assisted living. So they're in a situation where they can't afford to move. They want to stay in place. And a very, very surprising trend is that seniors are taking out equity in their homes, which they have a lot of, to be able to stay in their homes, make renovations, to be able to safely age in place and afford, hopefully, if there are any workers left, at-home care.
Additionally here, Meredith, since we're talking about the generational breakdown here, you think about so many of the new home buyers, first-time home buyers, and I think about millennials as well here, who are also still much of the generation, and Gen Zers who are starting to become first-time home buyers as well, saddled with student loan debt. This has been something that's called out upon the banking sector outlook. I was taking a look at Apollo chief economist Torsten Slok's outlook here, saying that student loan repayments are actually going to push many borrowers or repayers into default. And so that could be happening soon. That could impact wage garnishment as well. To the extent that overflows into the housing scenario, what kind of picture are we looking at as a knock-on effect?
Well, I look at that split in generations as the avocado toast generation. It's people between 24 and 38, and they don't own homes for the most part because they can't afford to own homes. But what they have been doing has been spending all of their discretionary income. And of course, not owning a home, you have more discretionary income. It's been cheaper to rent than it has been to own homes because of escalating property insurance and property taxes. So you're going to see spending from the avocado toast generation that has been with the high-end generation really like driving this, the high-end consumer really driving this economy. That's going to slow down. And I think Torsten's right about student loans. Now, the other issue is when a consumer loses skin in the game, and there's been such a forbearance for student loans for so long that once they are required to pay the student loans again, there's somewhat of a shock to the system, and there's a natural default cycle. Versus if they were paying a minimum amount into this down for their student debt. I think that's just consumer trend that you see in so many so many lending products. But student loans, 1.6 trillion outstanding, is going to be a big bite for the economy for sure.
You've got a compounding of issues that home buyers are thinking about right now, whether that is how much they're going to be paying for a home and the affordability of it, as either driven by what tariff policy flow through or the input costs for wages could mean, especially as we're seeing a crackdown on immigration. And then additionally, just where they would like to live, of course, in location itself. All of those things considered, is the dream of owning a home, is it still attainable for those who are really trying to figure out where they can get the best bang for their buck right now?
Well, where people want to live, it happens to be the most expensive properties. If you want to move to Erie, Pennsylvania, you could probably afford a home. If you want to move to parts of Ohio, you could probably afford a home. But where people want to live is there's a shortage of housing supply, and you have a combination of high home prices and high rates. Typically, when rates go up, values go down. That's the how the math works, and that has not happened. So rates have gone up. How home prices continue to go up, and actually, there's not that much activity, and that's what's keeping the home prices skewed towards the high end. The low end, there's very little activity. So people with means are moving, and people without are staying put and struggling to stay and age in place.
As we think about what's working its way through Congress right now, and what's been called by President Trump the big beautiful bill, does there need to be more of an effort to incentivize home purchasing?
Look, I think that home purchasing is good for any economy and any socialization, right? You put down roots. You're committed to the community. You're committed to paying your loans. You're committed to holding down a job. It has so many good things. Now, I just don't think that this environment, and also people are the 5 Ds, diamonds, diapers, divorce, forget what the four, and death.
Yeah.
Those aren't happening because people are putting off getting married. So what you see is single women are buying homes, but married couples are that dream is being put on ice.
Yeah. Meredith, thank you so much for taking the time here with us today. We got to sprint to the opening bell. Thank you.
Great questions. Thank you.
Confidence among U.S. homebuilders in June hit its lowest level since December 2022, as high mortgage rates and policy uncertainty hit would-be buyers. With more on the landscape for homebuilders, we have Katie Hubbard, Walton Global's Executive Vice President of Capital Markets, joining us now. So, Katie, there was actually an expectation we would see sentiment rebound here. Clearly not the case. What does this tell us about where homebuilders and really the overall housing market stand right now?
Yes. Hi, Allie. Thanks so much for having me. So homebuilder sentiment dropped to 32 from 34, went down slightly. We were expecting it to increase. However, that is surveying over 400 homebuilders across the U.S. And our clients, Walton, we have public homebuilders as our clients, and they're definitely not seeing that negative sentiment. But if you're Bob the Builder and you're not able to have the same really tools in your toolbox as public builders buying down mortgage rates and offering incentives, then your sentiment is definitely down because affordability and just consumer confidence is keeping people on the sidelines.
And overall, the outlook here has been cautious, and you pointed to some bumpiness in the home builder data over the past few months. What will it take to reach that full rebound? Is it more clarity on tariffs? Is it a step down in mortgage rates? All of the above?
It really is all the above. I mean, right now we're seeing an all-time high of 27% of people aged 25 to 34 are now on the sidelines. We have 650,000 people in that age group that have, since 2023, moved in with their parents or grandparents, and another 250,000 25 to 34-year-olds have moved in with roommates. So they're really on the sidelines waiting for rates to come down, just that consumer confidence. And so it's keeping people on the sidelines. But the fundamentals of demand, the demand is there. It's just what we're seeing is that the large public home builders, it's not as much of a problem for them on the on the home builder confidence. They're going to build through this cycle. They've learned in past cycles that if they pull back or they lose any land positions, the demand is still there, so they're going to go through it. What's happening though is smaller builders that can't really compete, they're probably going to be the ones that are turning in the keys, and they're going to be selling to the large public home builders. But we really need, rates to come down closer to 6. They're now today at 6.72 on the 30-year fixed, and that's just keeping people on the sidelines.
So demand is still there, but where are you seeing the biggest cracks? You mentioned some of that younger cohort of buyers. Is it more entry-level buyers that are staying on the sidelines at this point?
It really is, but if you go into a public home builder community, they will buy down your mortgage rate. And so if the mortgage rate is the issue and you go into one of those communities, they're going to do anything that they can. Even going to 0% margins and really building the house for practice to get that home sold. So it's really pace over price for public home builders. And then on the flip side of that, the positive is you've got 55 plus communities are doing very well. We've got 12 million people that are going to be hitting that 55 plus age bracket over the next 8 years. And that's where the wealth is. There's $112 trillion in wealth locked up in people born before 1970. And that group of people, they're really going down, selling their houses and going into smaller houses. They want to go to master plan communities with amenities like pickleball courts and, wealth and health and wellness. And it's not like, our grandparents, it's a different type of generation at that 55 plus where they're healthy, they're wealthy, and they're tech savvy. And so if you're a builder that can build amenities to that genre and that group of people, then you're also going to do very well, similar to the entry-level home builders. But if you're in that middle bracket, building 5,000 square foot houses on acre lots, those are the groups that are really struggling.
Mortgage rates for the week ending June 26th are out. Yahoo Finance's Claire Boston joins me now with the numbers. Claire, what do we know?
Hi, Brad. This week, the 30-year mortgage rate is at 6.77%. That is down slightly from 6.81% a week ago. 15-year mortgage rates are now at 5.89%, down from 5.96% last week. So we are inching down. We have been inching down for several weeks now. This is actually the lowest we have been since early May. That being